welcome to G Fun Facts Online. Today, we're talking about money. Not stocks, not crypto, but the very nature of the dollars, euros, or yen you use every day. A quiet but massive revolution is underway, happening right now in the servers of central banks. It's called a Central Bank Digital Currency, or CBDC, and it represents one of the biggest changes to money in centuries. Over 130 countries, representing 98% of the world's economy, are already exploring, building, or launching their own. This isn't just about paying with your phone. It's a fundamental rewrite of our financial system. So, what exactly is this digital currency revolution, and how will it change your life? Let's dive in. To understand why CBDCs are so revolutionary, we need a quick trip through the history of money. We started with barter, which was inefficient. Then came commodity money, like salt and cattle, followed by a huge leap, metal coins, which were durable and divisible. Then, another revolution in Tang Dynasty China, paper money. This was lightweight and convenient, eventually leading to the fiat money we use today, money that has value simply because a government says it does, and we trust them. In the last few decades, money went digital. We use credit cards, bank transfers, and apps. But here's the crucial detail most people miss: that digital money isn't a direct claim on the central bank. It's a liability of a commercial bank like Chase or Barclays. It's essentially a promise from your bank to pay. A CBDC is different. It's a direct liability of the central bank, just like the physical cash in your wallet. It's government-issued digital money. This subtle distinction is the heart of the entire revolution. Central banks are pursuing this for a few key reasons. First, the use of physical cash is plummeting. Second, the rise of private cryptocurrencies like Bitcoin and stablecoins like Tether has shown both the demand for digital assets and the potential threat they pose to national monetary control. Governments want to offer their own stable, official alternative. The future of money is digital, and governments want to be the ones who issue it. So how would a digital dollar or a digital euro actually work? At its core, a CBDC is just a digital version of a country's currency, existing on a secure ledger controlled by the central bank. But the details are incredibly important. The first big design choice is whether it's for wholesale or retail. A wholesale CBDC is for big financial institutions to settle transactions between themselves. It's like upgrading the plumbing of the financial system. It's important, but it won't directly affect most of us. The real game changer is the retail CBDC, designed for everyday use by people and businesses. This is where things get interesting, and central banks are exploring three main ways to build it. First is the direct model. Here, the central bank would manage everything. It would open your digital wallet, process your payments, and handle customer service. This would create a direct link between you and the nation's central bank, but it's a huge operational task. Imagine the Federal Reserve running a call center. Second is the indirect model. This looks a lot like our current system. The central bank issues the CBDC to commercial banks, and those banks handle all the customer-facing services. You'd get your digital wallet from your local bank. This leverages existing infrastructure, but it also retains some of the old system's inefficiencies. The third option, and the one many see as the most likely, is the hybrid model. This tries to get the best of both worlds. The CBDC would be a direct claim on the central bank, making it super safe. But private companies, like banks or fintech apps, would handle the wallets and payments. The central bank would just maintain the master ledger in the background, ensuring everything is secure. Another key choice is the technology. While inspired by cryptocurrencies, most CBDCs probably won't use a public blockchain like Bitcoins. They'll use either a traditional centralized database, which is fast and controllable, or a permissioned blockchain where only authorized parties can participate. In either case, the central bank remains firmly in control. Finally, and perhaps most critically for our privacy, is whether the CBDC is token-based or account-based. A token-based CBDC would work like digital cash. The value is in the token itself, which you could transfer anonymously, much like handing someone a $20 bill. An account-based CBDC, on the other hand, would be tied to your verified identity. Every transaction would be recorded on an account linked to you. This makes it easier to fight crime, but it raises huge privacy questions. The global push for CBDCs is fueled by a list of potential benefits. The most cited is financial inclusion. Around 1.6 billion people worldwide don't have a bank account. High fees, lack of documentation, or just living too far from a bank branch locks them out of the formal economy. A CBDC, accessible through a simple wallet on a basic mobile phone, could change that. It could provide a safe, low-cost way to store and transfer money, allowing people to save, get credit, and participate in the digital economy. Another major promise is enhancing payment efficiency. CBDCs could make payments instant and dramatically cheaper by cutting out intermediaries. This is especially true for cross-border payments, which are notoriously slow and expensive. Imagine sending money to family overseas in seconds for a fraction of a cent. International projects like mBridge are already proving this is technically possible. Finally, CBDCs could give central banks powerful new tools for monetary policy. For instance, a CBDC could be designed to be interest-bearing. The central bank could directly raise or lower the interest rate on the digital cash in your wallet to encourage or discourage spending. In a crisis, they could airdrop stimulus payments directly to every citizen instantly, bypassing the slow and clunky process of mailing checks. But for all their promise, CBDCs come with a dark side, presenting enormous risks that we have to confront. The biggest and most chilling concern is the death of financial privacy. Physical cash offers anonymity. A CBDC, especially an account-based one, could create a permanent, searchable record of every single transaction you ever make. Augustin Carstens, head of the Bank for International Settlements, put it bluntly. He said with a CBDC, the central bank will have absolute control on the rules and regulations, and the technology to enforce that. In an authoritarian regime, this is a terrifying tool for surveillance and social control, allowing a government to monitor and even block the transactions of political opponents. But even in democracies, a centralized database of every citizen's financial life raises profound privacy issues. The second major risk is to financial stability. Imagine a financial crisis is brewing. People get scared. With a CBDC, they could pull all their money out of commercial banks and move it into the 100% safe central bank digital currency with a few taps on their phone. This could trigger a